It was mentioned on a previous episode of The Income Generation that I hold a U.S. Coast Guard captain's license, specifically a 100-ton master license. Now, as you might know, during the training for this authorization, and also during the intense training I went through before becoming a private pilot, I was required to study weather. While training for the FAA and the Coast Guard tests, there was a concentration of education centered on recognizing storms as well as other bad weather. Specifically, being able to recognize their forming so I could navigate away if the craft is already committed, or keep both feet on what feels like solid ground until the conditions clear. There are many parallels I can draw between weather cycles and economies and markets. The one that's most important for today's show is the understanding that when one major storm is past, we may celebrate its end, but not a person on this planet expects that they'll never encounter another bad storm in their lifetime. It's a fact of life, and similar to weather, once the economy or the markets begin to shine through dark clouds and people are feeling good about the future, no one should expect that an economic storm or market bubble won't ever happen again. Not with weather, not with markets, not with the economy. But people get caught up in frenzies, and for reasons that we'll discuss during this hour, they act far less rationally than you would think intelligent beings ever would. Why? Why would people have short memories and not recognize that market movements are man-made and man is subject to fear, greed, hope, indulgence, and fantasy? There's a long list of emotions that drive human behavior. And once the behavior is fueled by a crowd, rationality is the last thing anyone is willing to pay attention to. Investor John Templeton once said it best. The four most expensive words in the English language are, "This time, it's different." Today's goal is to help you discover individually how to recognize the signs of economic storm formation. And at the end of the show, you'll be able to keep your bubble radar on at all times, especially when viewing opportunities. Hopefully, I'm not opening any painful scars if I bring you back to the last decade in the real estate bubble or the stock market crash, or back to the 1990s when the high-flying NASDAQ existed, and we read a lot of dot-com millionaires that existed at the time. Back then, America seemed to be riding an endless wave of soaring stock prices. That frenzy was even fueled by the investment news shows that repeated, "Nothing like the tech boom had ever happened before, and it doesn't appear to have an end." But it had happened before. In fact, it was just the latest chapter in human history of group hysteria driving prices to irrational levels, pushing them up to the stratosphere, and then pushing them even higher. It's happened many times before. One of the first recorded and most famous occurrences was in the 1630s with what's often referred to as tulip mania. This was in Holland, and during this period, the Dutch were becoming obsessed with trading tulip bulbs. Growers, including amateurs, would bid up the prices, especially on those bulbs that may win awards. It quickly became more and more popular. The market grew and became so large that an adjunct to the Amsterdam Stock Exchange was set up to accommodate the high volume of tulip trading. The market for tulips began raging to the point where people were investing fortunes for simple plant roots. Soon, anyone with at least a few square feet of space in their yard was growing bulbs. At first, it paid off. The price momentum of bulbs stayed positive. Stories of common gardeners became rich, and these stories were heard everywhere. People even quit their jobs to cultivate tulip bulbs. During the height of tulip mania, that period between 1634 and 1637, the price of the most sought-after tulip bulbs reached the equivalent of paying $110,000 in today's dollars. Looking back, this sounds crazy, but back then only a few cool heads warned of an impending disaster. And most were ignored. They were greeted with greed and the everyone's doing it or I don't want to miss out mentality that prevailed at the time. But the false prosperity didn't last. Suddenly in 1637, it completely unraveled. At first, only a few wanted to convert tulips to other assets. Then when buyers became harder and harder to find, the prices dropped about 25%. Then even more sellers entered, and the downward spiral took tulips and the whole economy with it. History is filled with examples of frenzies like this, followed by severe economic storms. I should note the people who often benefit the most from these are those helping support the activity, but not actually engaged in it. What do I mean by that? Well, for example, Levi Strauss and those making picks and shovels were the real winners of the California gold rush. And the stockbrokers and mutual fund companies benefited greatly from many of the country's great market buildups. In fact, during the real estate boom, one of my neighbors, who was a mortgage broker, traded in her Volvo and actually went out and bought a Bentley. And a real estate broker I met had his and hers Rolls Royces. They all provided the means for others to try to get rich, but stayed out of the game themselves.